Welcome to The Explainer. Today we are diving into the world of private markets. You know, that space that for the longest time was pretty much off limits unless you were super wealthy. We're going to look at two really interesting ways more and more investors are getting access: business development companies and interval funds. Let's figure out what they are and how they actually work. Okay, here's our game plan. First, we'll get into why private markets are absolutely booming right now. Then we'll introduce our two main players. After that, it's time for the main event, the head-to-head showdown. And we'll wrap up by figuring out what it all means for you as an investor.
All right, first things first, let's set the scene. You hear these huge names, right? Blackstone, KKR, and you probably picture this exclusive high-finance world where all the big deals happen behind closed doors. And you know what? For a long time, that's exactly what it was. Private investing was like a walled garden. You just couldn't get in unless you were a big institution or a high net worth individual. But those walls are definitely starting to crumble.
So what changed? Well, a lot of it goes back to the 2008 financial crisis. After that whole mess, new regulations made banks a lot more cautious about lending. And that hesitation created this massive void, this huge opportunity for non-bank lenders to jump in and fill the gap.
And when I say massive, I mean it. Just look at this number. The private credit market is projected to hit nearly $2.8 trillion. That is an absolutely staggering amount of capital that used to be incredibly hard to get to. So, the big question is, how can more everyday investors get a piece of that action?
Well, this explosion in growth has given rise to some new ways to invest. So let's meet the two main contenders that are designed to open those doors: BDCs and interval funds. First up, we have business development companies, or BDCs for short. Now, these are interesting because Congress actually created them with a very specific mission: to be a source of funding for America's small and mid-sized businesses. It's literally written into their DNA. By law, at least 70% of their money has to go toward helping these companies grow.
And in the other corner, we have interval funds. Now, these are also a type of closed-end fund, but their claim to fame, their key feature, is a built-in escape hatch for investors. They have a preset schedule where they have to offer to buy back shares, giving you a predictable way to cash out if you need to.
So on the surface, they sound a little similar, right? Both offer a way into private, less liquid assets. But as always, the devil is in the details. So let's put them side by side and really dig into the crucial differences.
Okay, this is where the rubber meets the road. This chart lays it all out. We're going to focus on the four big battlegrounds that really matter to you as an investor: getting your money out, what's actually in the fund, how much risk they're taking on with borrowed money, and of course the fees. Let's break them down one by one.
First up, and honestly this is a huge one, liquidity. How do you get your money out? With an interval fund, it's scheduled. You know that, say, every quarter they have to make an offer to buy back shares. With a BDC, it's discretionary. The funds board gets to decide if and when they'll make an offer, and it's often a smaller amount. It's the difference between a scheduled ferry and a boat that might show up.
Next, let's look under the hood. What are you actually investing in? A BDC is a specialist. It's got that legal mandate to focus on funding those smaller U.S. companies. An interval fund, on the other hand, is more of a generalist. It has a ton more flexibility to invest across a whole universe of different alternative assets. We're talking everything from real estate to all kinds of private credit.
And finally, let's talk about leverage. That's just a fancy word for borrowed money. This is a massive difference. BDCs are legally allowed to use a lot more of it. They can borrow up to $2 for every $1 of equity. Now that can really juice up returns, but it also ramps up the risk. Interval funds have to be way more conservative with a much lower legal limit.
So, after all that, we get to the most important question. How do you possibly choose? The truth is, there's no single best option here. It really all boils down to a trade-off between what you want to invest in, how much you value liquidity, and your personal tolerance for risk.
Look, here's a pretty simple way to think about it. If you want to make a very specific bet on the growth engine of the U.S. economy, those small and mid-sized businesses, and you're okay with not being able to get your money out on a dime, a BDC can be a powerful tool. But if you prioritize knowing you'll have regular chances to cash out, and you prefer a broader, more diversified portfolio, then an interval fund might be a much better fit for you.
This whole trend, this democratization of finance, is really powerful. But it leaves us with one final critical question to chew on. As these doors to the private market swing open, who really stands to benefit the most? Is it the everyday investor finally getting a seat at the table? Or is it the financial giants who are building these products?
it's more important than ever to really understand what's on the other side of that door. Thanks for joining this explainer.